move 39 million ounces of silver at 90 bucks an ounce or 85 bucks an ounce. Do the math. You're talking billions of dollars getting on a procession of trucks and going where? In silver and gold, they should never be in backwardation. They should be in contango. $4.2 billion worth of gold left last week out of the GLD account. Major institutions are sourcing shares and redeeming baskets and pulling bullion out of the ETF inventory without needing a loud public gold shortage headline. It's a big deal. It's the immediate value for delivery that creates it. So you see some sort of a force majeure or a failure to deliver in London. And remember, London has no exchange. It's an over-the-counter. It's mano a mano, kind of like eBay, except without the eBay in there and the intermediary to make things right if they go wrong. With COMEX, they'll just issue a cash settlement before it gets to that, which is the admission of failure to deliver. And that's when things begin to accelerate. The higher the price goes, the more freaked out you get. You're not doing it to become wealthy. Because I'm not going back into paper. London and the US in particular, even the Shanghai exchange is running tight. You look at COMEX, I looked at it yesterday, you could argue they're under visible delivery pressure. Their registered stocks in silver right now, as of yesterday, were 81.2 million ounces. That's roughly 16,250 contracts, 5,000 ounces apiece. But the open interest right now for the month of March is 112,700 contracts. So you're about 9 to 10 times the amount of paper as there are bars standing behind it. March deliveries have already reached about 6,615 contracts. That's about 33,100,000 ounces. This doesn't prove a COMEX failure, but it does show a much thinner registered cushion than, all the headline open interest might suggest. This is the same thing we've seen forever. Let's look at February for a moment. We always talked about less than 1% of contracts stood for delivery. Nearly all of them stood for delivery in February. In fact, 160% of the February delivery, or of what the February delivery could explain, left COMEX. Now, the numbers are a little bit, probably slightly off, because I didn't see the last settlement day, but a day before February went off the board, about 23, 24, 25 million ounces had stood for delivery. That means coming in from somewhere instead of cash settling, instead of rolling forward to probably the March contract or even May.
The silver market claims deep liquidity, yet the math quietly tells a different story. As Andy Schectman points out here, COMEX currently holds about 81 million ounces of registered silver against more than 112,700 open contracts for March, roughly a 9 to 10 to 1 paper to metal ratio. That gap doesn't automatically signal failure, but it does reveal how dependent the system is on most traders never asking for real delivery. February was even more revealing, with about 160% of expected delivery metal leaving the exchange entirely, a signal that someone prefers physical bars over paper exposure. Next, Andy Schectman discusses where those massive silver withdrawals may actually be going.
They stood for delivery. So it was one of the smaller delivery months, actually, and it isn't the primary delivery month as January and March are, but it was nonetheless a robust non-delivery month of about 25 million ounces delivered, but 38 million ounces left COMEX. So that's 160% of what was delivered actually left the building. Now ask yourself this question. If a mint box of Silver Eagles is 42 pounds, 500 ounces, who's taking possession of nearly 39 million ounces? Where is it going? Who's running logistics, insurance, the armada of trucks needed to pick it up, and where is it going? Is this the Exchange Stabilization Fund on behalf of the U.S. government, which could, if it were for national security, keep it quiet, need no congressional approval? I mean, I don't know. Could it be? Isn't silver just recently classified critical for national security, strategic? Yeah. So I would say that we are very close to, in both gold and silver, that moment where demand outpaces available supply. But it's even a little deeper in that. And one of the things I wanted to talk about was what happened in GLD last week. Now, it's always, as the media does a great job of, done again, framing it in a crappy light, because $4.2 billion worth of gold left last week out of the GLD account.
When nearly 40 million ounces of silver quietly leave an exchange, the real story is not the price chart, it's the logistics behind the metal. As Andy Schectman points out here, about 38 million ounces exited COMEX during a non-primary delivery month, despite only 25 million ounces being officially delivered. That raises an uncomfortable question for market watchers. Who is willing to organize insurance, trucks, and vault transfers for billions of dollars in physical metal? If silver has indeed been labeled strategically important in recent policy discussions, large institutional or government buyers quietly accumulating supply would not be unprecedented. Next, Andy Schectman discusses what a massive $4.2 billion gold outflow from GLD may actually signal.
In other words, in a single week, at all-time high prices, GLD recorded the largest single weekly outflow in its 20-year history, okay? So someone is selling the ETF, right? That's what they want us to think. That they want us to believe that, people are repositioning. But I look at it differently. I look at it as big interests in the U.S. do not want to telegraph their physical demand by bidding loudly in the open spot market, the market that we're talking about, COMEX, right? Because they can source GLD shares. The big money would be the authorized participants. They can source these GLD shares or create them and then redeem the baskets, which is 100,000 shares minimum, through their authorized participant channels. They can receive London good delivery bars through the custodial system. In other words, what I'm saying is that this is a lot deeper than people think. And I think that, look, only the authorized participants can redeem the baskets, and they are 100,000 shares minimum each. The fact that they can create and redeem shares in physical metal matters because these large outflows are looked at by the mainstream media as lack of demand, when in reality, as far as I'm concerned, it shows that trust is eroding within the system.
Headlines say investors are selling gold ETFs, but the mechanics of the system suggest something far more strategic. As Andy Schectman points out here, GLD saw the largest weekly outflow in its 20-year history, about $4.2 billion, even as gold prices were near all-time highs. Large institutions known as authorized participants can redeem 100,000 share baskets for physical London delivery bars, meaning ETF redemptions can quietly become a pipeline for physical metal. That flips the media narrative completely. What looks like selling may actually be discrete accumulation away from the public market. Next, Andy Schectman discusses how institutions may be quietly pulling bullion from ETFs and exchanges.
And, to me, it's that major institutions are sourcing shares and redeeming baskets and pulling bullion out of the ETF inventory without needing a loud public gold shortage headline. It's a big deal. So yeah, whether we see metal coming off of the exchanges or being siphoned out of GLD and SLD by the authorized participants, it's real. It truly is real. And the media does a horrible job of framing that. And I think by the time they do recognize it, it's that little by little, then bang all at once, then they'll report on it. It's too late at that point. And I think that's what you see happening through metal leaving COMEX, metal leaving Shanghai, metal leaving the LBMA, metal being pulled out of the ETFs. This is a big deal, and it happens slowly so as not to completely flip over the apple cart. Most people say, well, why not just buy it all, because the whole thing would end. So they've been doing it slowly. It's accelerating, and it's now becoming a little bit more visible.
Yeah, I wanted to put one more data point in there to what you just discussed in overview, and that is from David Jensen's interview most recently on our channel.
Financial markets rarely break suddenly. They usually drain slowly before anyone notices the pattern. As Andy Schectman points out here, metal leaving COMEX, London vaults, Shanghai exchanges, and ETFs may look like isolated flows, but together they suggest a steady relocation of bullion away from trading ecosystems. Institutions often move gradually to avoid triggering panic or price spikes, which means the public usually sees the trend only after inventories are already depleted. Historically, liquidity crises, from 2008 credit markets to the 2020 Treasury shock, followed this exact slow, then sudden pattern. Next, Andy Schectman unravels new data suggesting Shanghai's physical metal availability may be collapsing even faster.
He said that the Shanghai physical metal availability was already down 90% from where it had started at its peak, and that at the current run rate, 6.5% per day were being drawn down of that physical availability. If you do the math, that's about 16 days or so till you run dry. What kind of hijinks get pulled when you get close to zero on these exchanges to prevent that from running dry, and how long can that can keep getting kicked down the road?
I don't know, maybe you see a glitch like we've seen 4 times in COMEX, 2 on the upside, and then the circuit breaker's not working twice on the downside. I think you get closer and closer to a force majeure. If we look at the COMEX as an example, you know, they like to when they talk about numbers, first of all, the eligible category is not for sale, but when they talk about deliverable numbers, they typically will take the entire registered category and half of the eligible category, because in theory, higher prices could pull a lot of that eligible metal into the market. What it really means to me is that you're going to need much higher prices to incentivize that metal that is sitting ineligible to move into registered.
A 90% drop in available metal is the kind of statistic markets usually ignore, right until liquidity suddenly disappears. As Andy Schectman points out here, Shanghai's physical inventory may be declining by as much as 6 to 12% per day, implying barely a couple of weeks of supply at current drawdown rates. Exchanges often mask stress by counting eligible metal that technically exists in vaults, but isn't actually for sale unless prices rise dramatically. That accounting trick keeps markets calm on paper, while real inventories quietly tighten. Next, Andy Schectman unravels why backwardation in gold and silver markets signals a deeper erosion of trust.
It's not good. It isn't good because what it really does, through the manipulations of the markets, which, let's just face it, we can't even discount the fact anymore that markets are manipulated, right? And because of that, trust in the institution has been eroded, and that's why you've seen the market in backwardation for so long. And in silver and gold, they should never be in backwardation. They should be in contango, where the spot is worth less than the futures, because the future takes into account storage and the cost of money. Interest costs money to store it, costs money to leave it out there. And the fact that it isn't really is a very big hint to the fact that trust is eroding. When you have a system done, again, that's completely based on trust, as this entire Western edifice is, when the trust starts to crumble and you start to see the big money stand for delivery, and not just stand for delivery, but leave the ecosystem, it should be a major wake-up call to everybody. And I think it doesn't portray for an orderly market when the biggest money on the planet is standing for delivery.
When gold or silver slips into backwardation, it quietly signals something far more serious than a temporary pricing anomaly. As Andy Schectman points out here, precious metals are normally in contango because storage costs and interest rates push futures prices above spot. When the opposite happens, it suggests traders want metal today more than paper promises tomorrow, a rare condition in commodities. Historically, backwardation tends to appear during periods of extreme trust breakdown or supply stress, something markets last saw in pockets during the 2008 financial crisis. Next, Andy Schectman discusses why large institutions physically removing metal from exchanges sends a powerful signal.
And moving it out in amounts like we are seeing, where you're talking literally a procession of semi-trucks leaving the safety of the COMEX ecosystem, the liquidity of the ecosystem. Now, we would rather pull it out. And let's just say one other thing. When those 1,000-ounce bars are stacked into semis and gone, the minute they're loaded onto the semi-truck, it is outside of the COMEX ecosystem. To resubmit it would be a huge cost and a massive time drag, as that they would need to be reassayed and submitted into the COMEX ecosystem. So they're never coming back. Where are they going? Who's taking them? What's being done with them? That's the big money moving ahead of everyone else. So yeah, it's not a good omen.
Can you talk to us briefly, and you've touched on it and hinted at it, but what do you foresee happening if indeed one of or more of these exchanges run out of available physical to be redeemed? What would be some likely kinds of consequences that we would observe if that happened?
Well, I think ultimately you're going to see pricing move eastward, where the concept of futures market controlling the price is something that when it was built.
The moment physical metal leaves an exchange vault, it effectively exits the financial trading system. As Andy Schectman points out here, once those 1,000-ounce bars are loaded onto trucks and transported elsewhere, returning them to COMEX requires expensive reassaying and administrative hurdles that make it unlikely. That means every withdrawal quietly reduces the liquidity cushion that paper traders rely on to settle contracts. For investors, this matters because price discovery depends on trust in available supply, something that weakens if large players prefer holding metal privately rather than inside exchange ecosystems. Next, Andy Schectman talks about why global pricing power may shift away from Western futures markets.
It was built under the right spirit, or with the right spirit, where you're using it to offset risk, to hedge risk. A gold producer mining gold can sell it forward, his production, at an adequate price, removing the risk, and the jeweler or the fabricator who needs the gold and silver, who takes the other end of that contract, is happy that their source is guaranteed. Or a farmer planting a field of wheat in April is concerned about the growing season, but the baker who needs the wheat in September is happy to take the future production at this price. Everyone is happy. You offset risk of your operations. Well, when it becomes a gambling casino, you have problems where big money can control the price of a commodity through the futures market. That's the tail wagging the dog. It shouldn't be that way. And I think it will ultimately move eastward to places like Shanghai, to places like Dubai, to places like St. Petersburg, the new Brinks exchange. All of these places around the globe that value gold and silver perhaps in a different way, and mostly on a cash and carry basis, where it's not a futures price creating it.
Futures markets were designed to reduce risk, yet today they often dominate the price of the very commodities they were meant to stabilize. As Andy Schectman points out here, hedging originally allowed miners, farmers, and manufacturers to lock in prices while protecting against volatility. But when speculative capital overwhelms real supply and demand, the futures market can start dictating prices instead of reflecting them. That shift matters because countries like China, Russia, and Gulf financial hubs increasingly prefer physical settlement markets over leveraged derivatives. Next, Andy Schectman unravels what happens if global price discovery for gold and silver begins moving east.
It's the immediate value for delivery that creates it. So you see some sort of a force majeure or worse, or a failure to deliver in London. And remember, London has no exchange. It's an over-the-counter. It's mano a mano, kind of like eBay, except without the eBay in there and the intermediary to make things right if they go wrong. With COMEX, they'll just issue a cash settlement before it gets to that, which is the admission of failure to deliver. And that's when things began to accelerate. So I have always felt that price setting was a privilege that we squandered and we disrespected, and ultimately is being used against us right now by the rest of the world, using the stupid prices that we create through suppression with leverage to stand for delivery. And when there's nothing left to deliver anymore, or when you see a massive failure to delivery, which is papered over with cash, it is the same thing, and you will start to rapidly see the world reprice gold and silver in what they believe is the fair, real price, not that make-believe price that is controlled by the futures market.
A market can pretend everything is stable right up until the moment physical delivery actually matters. As Andy Schectman points out here, London's gold market operates largely over the counter without a centralized exchange safety net, meaning trust rather than transparency keeps the system functioning. If a failure to deliver occurs, COMEX can technically settle contracts in cash, but that move effectively admits the paper market no longer represents real supply. History shows once price discovery loses credibility, global capital rapidly searches for alternative benchmarks. Next, Andy Schectman unravels why tightening supply doesn't always force metals investors to sell, even at higher prices.
Yeah, I think you alluded to that a little bit ago when you talked about the cash and carry markets such as Shanghai, where David Jensen was saying there's this asymptotically approaching the zero bound on available, is that you're saying that's available at or near the current prices, that's prices, then the solution to lack of liquidity is higher prices that would potentially free up. But you've talked to us about that's a trick in precious metals, because those are safe haven, safe harbor type assets. So when it looks like there's a pinch, the grip sometimes get tighter rather than looser on people being willing to relinquish those at higher prices. Any comments on that before we move on?
Yeah, well, that's true. That's why they say there's no bull market like a metals bull market. The higher the price goes, the more freaked out you get. You're not doing it to become wealthy. You're doing it because as the price goes higher, you're not selling it because you're greedy. You're selling it because I'm not going back into paper. I'm not going back into dollars. And everything that I thought that I learned from Dunnigan and others is right. And I've been told I was an idiot forever for owning this stuff, and now look at it and I'm right. And it's not about making money. This is what people would think. It's about I'm scared to go anywhere else. And that's why there are no bull markets like gold bull markets or metals bull markets, because the higher the price goes and the scarier the world gets, reinforces the thought you had to buy it in the first place. Therefore, you're not going back into dollars, and you're not doing it to get wealthy. You're doing it to get out of the way of the steamroller that's coming down your way.
Rising prices normally encourage sellers, but safe haven assets often behave in the exact opposite way. As Andy Schectman points out here, when investors buy gold or silver for protection rather than speculation, higher prices can actually make holders more reluctant to sell. That dynamic appears during periods of geopolitical stress, inflation spikes, or financial instability, when the goal shifts from profit to capital preservation. The 1970s gold rally showed a similar pattern, where fear of currency erosion drove demand even as prices surged. Next, Andy Schectman discusses why major Wall Street institutions are now recommending unusually large allocations to precious metals.
Yes, we've talked about what the chief investment officer of Morgan Stanley said: sell half your bonds, by 20% of your assets in gold. You have Michael Hartnett from Bank of America put 25% of it in. Jeffrey Gundlach, the bond king, 25% is not overweight. You know, you've got all of these analysts speaking at the highest of levels, telling people that 25% of your assets in gold and silver is not out of line. And when you realize it represents 1% or less, to your point, yeah, just a small fraction of it comes in. And then you see things like what we see here in Florida, where the legislature it's passed the House and the Senate now, where, you know, they're calling American Eagles legal tender for all debts, public and private, and they will issue a state-sponsored vaulting system like in Texas to put your metal into, and have an app that allows you with no sales tax to purchase stuff in the state. And so, but the point of it is that these are the things that will wake up the constituents of these states. You throw into it war and the cost of war, and which will mean more debt issuance, more monetization, more printing, more inflation. I think there will be an awakening by people that you buy gold and silver not to become wealthy.
When major Wall Street strategists start recommending double-digit allocations to gold, it signals a shift in institutional thinking. As Andy Schectman points out here, analysts from firms like Morgan Stanley and Bank of America have floated allocations as high as 20 to 25% of a portfolio, levels rarely discussed during stable monetary periods. That matters because gold and silver still represent a tiny slice of global investment assets, often under 1% of total portfolios. If even a small portion of bond or equity capital rotates toward metals, supply dynamics could tighten quickly. Next, Andy Schectman talks about why insiders may already be quietly accumulating physical silver.
But because it is wealthy, that the most well-informed traders in the globe, first the central banks for the last several years, and now whoever the heck's doing it here at home to the tune of billions every single month, not just taking it and leaving it in COMEX, but even more of an indictment of the lack of trust. Leaving COMEX, 160% of what was delivered in February is gone. And so what does that mean? Is it accelerating? Is the lack of trust accelerating? Do the people inside this ecosystem who have the ability to stand for possession and move 39 million ounces of silver at 90 bucks an ounce or 85 bucks an ounce, do the math. You're talking billions of dollars getting on a procession of trucks and going where? So the point of it is that yes, this is happening and the insiders always move before everyone else does. And is that what we're seeing? Don't know. The fact that the media hasn't even sniffed it is pathetic to me, but it to me is an indictment of the entire system and of the COMEX and of, what it means for the future in terms of their ability to keep the exchange going without completely blowing up through an erosion of trust and confidence.
Markets rarely announce structural shifts. The earliest signals usually appear in quiet inventory movements. As Andy Schectman points out here, roughly 160% of the silver delivered during February actually left the COMEX system entirely, meaning far more metal exited vaults than contracts required. Moving nearly 39 million ounces, at prices around $85 to $90 per ounce, represents billions of dollars relocating outside exchange control. Institutional investors historically move first in major commodity cycles, while public awareness comes much later.